Index versus mutual fund. Fee strategy. Worth $67,000. If you're over 60 and have more than $250,000 saved for retirement, here's a number you can't afford to ignore. The average retiree will lose $67,000 to unnecessary investment fees simply by choosing the wrong type of fund. Let me repeat that. $67,000 gone just from fees. In my 3 decades of guiding seniors through successful retirements, I've seen this overlooked mistake devastate nest eggs that took a lifetime to build. Many retirees believe all funds are basically the same, but the difference between index funds and traditional mutual funds can mean thousands more in your pocket, or less for your family. The sooner you understand this, the more control you have over your financial future. My clients typically see their savings stretch further simply by making smarter choices with their investments. This is educational content designed to help you make informed financial decisions. Always consult with a qualified financial advisor for your unique situation, and remember, past performance doesn't guarantee future results. Today, I'm going to show you the exact strategy that could help you avoid this costly mistake, potentially saving you tens of thousands over your retirement. By the end of this video, you'll know precisely how to spot hidden fees and protect your legacy. But first, let me share the critical difference most investors never see. Pay close attention because missing this could change everything. Part 1. The hidden cost of choosing the wrong fund. Let's start with a question that's more important than most retirees ever realize. How much of your hard-earned retirement savings are quietly slipping away without you even noticing, simply because of the type of investment fund you've chosen? In my 30-plus years of helping retirees protect and grow their nest eggs, I've seen this overlooked decision cost seniors tens of thousands of dollars. And the truth is, most people don't even realize it's happening until it's far too late to recover those lost funds. Now, I want you to take a moment and really think about this. The average American retiree will pay between $67,000 and $120,000 in mutual fund fees over a typical 25-year retirement. That's not a typo. According to a recent study by the Center for Retirement Research at Boston College, the average mutual fund expense ratio is about 1.25% per year, while index funds can be as low as 0.05%. Over the course of 25 years, on a $300,000 portfolio, that difference adds up to over $67,000 in extra fees. Money that could have gone directly into your pocket, your travel plans, or your grandkids' college fund. Let me repeat that critical point for emphasis. $67,000 lost to fees just by choosing the wrong fund. That's enough to buy a new car every decade of your retirement, or to cover several years of out-of-pocket healthcare costs. And yet, nearly 70% of retirees over the age of 60 still own actively managed mutual funds, paying fees that silently erode their savings year after year. Why does this happen? For most, it comes down to trust in a familiar brand name, or in a financial advisor who may not always have your best interests front and center. Many retirees are told that mutual funds are professionally managed and will deliver better results. But the reality is, according to Morningstar's long-term research, more than 80% of actively managed mutual funds fail to outperform their benchmark index over a 10-year period, even before you factor in taxes and fees. That means you're not just paying more, you're often getting less. I've seen thousands of seniors come into my office with statements showing mutual fund expense ratios of 1.5% or even 2% per year. On a $400,000 portfolio, that's $6,000 to $8,000 every single year, just in fees. Over 20 years, that's $120,000 or more gone. And here's the part that's truly alarming. Many of these fees are buried in fine print, deducted automatically, so you never even see the money leave your account. It's like a slow leak in your retirement bucket, one that can drain your resources much faster than you think. Now you might be thinking, but my advisor told me these funds are worth the cost because they're managed by professionals. I hear this almost every week. And while there are certainly some skilled fund managers out there, the data shows that historically, the vast majority underperform simple, low-cost index funds, especially after accounting for fees and taxes. Let's put this into perspective with a real-world example. Suppose you're retiring at 65 with $500,000 invested. If you're paying 1.5% per year in mutual fund fees, that's $7,500 every year. If you lived another 20 years, that's $150,000 in fees, enough to fund several dream vacations or to give each of your grandchildren a substantial start in life. By contrast, if you switch to an index fund charging just 0.05%, your annual fee drops to just $250. Over 20 years, you'd pay only $5,000 in fees, a savings of $145,000. That's money that stays in your account, compounding for your benefit, not someone else's. Here's another statistic that's hard to ignore. According to the Investment Company Institute, over 60% of retirees believe their mutual fund fees are reasonable. Yet, when shown the actual dollar amount paid over 20 years, nearly 80% say they would have chosen differently if they'd known the true cost. The problem isn't just the size of the fees, it's how invisible they are and how rarely advisors or fund companies bring them to your attention. I want to be clear, this is educational content, not personalized financial advice. Every situation is unique, and you should always consult with a qualified financial advisor before making changes to your portfolio. But it's crucial to understand that even small differences in fees, fractions of a percent, can have a massive impact on your retirement lifestyle over time. The most successful retirees I work with are the ones who take the time to understand exactly what they're paying and who make deliberate, informed choices to protect their savings. Let me share a quick story. A couple I worked with, both retired teachers, came to me with $350,000 in mutual funds. Their average annual fee was 1.4%. They had no idea they were paying nearly $5,000 a year in fees. We reviewed their options, and they decided to transition to a blend of index funds and ETFs, reducing their average fee to just 0.09%. Over the next 15 years, that simple change saved them more than $60,000, money they used to help their grandchildren through college and to fund several trips they'd always dreamed of taking. Now you might wonder why this issue is even more urgent for retirees over 60. The answer is simple. Once you stop working, every dollar counts. You no longer have a paycheck to make up for lost ground. The window to recover from costly mistakes is smaller, and the impact of fees compounds even faster. Every dollar you lose to unnecessary fees is a dollar you can't use for health care, travel, or leaving a legacy. And with people living longer, many well into their 80s and 90s, the cost of fees over a 25 or even 30-year retirement can be staggering. In my experience, the wealthiest and most financially secure retirees are the ones who are vigilant about fees. They know that a conservative, safety-first approach doesn't just mean avoiding risky investments. It means avoiding unnecessary costs at every turn. Industry insiders know this secret, but it's rarely discussed openly. Why? Because those fees are a major source of profit for many financial institutions. The less you know, the more they make. Let me repeat that. The less you know about your fees, the more someone else profits from your hard work. That's why it's so important to take control now, before you lose another dollar unnecessarily. So far, we've covered the shocking reality of how much fees can cost you in retirement and why this issue is even more critical after age 60. You've seen the numbers, the statistics, and real-life stories of retirees who've been impacted both positively and negatively by their fund choices. But here's what most financial advisors won't tell you. There's a proven conservative strategy to dramatically reduce your fees, increase your peace of mind, and potentially add tens of thousands of dollars back into your retirement plan. The solution is simpler than you think, but most people get it wrong. Part 2. The simple, powerful solution. Why index funds are a game changer for retirees. Let's build on what we've just uncovered about the hidden cost of mutual fund fees. If you're like most retirees I've worked with over the past 30-plus years, you might be feeling a mix of frustration and urgency right now. You've worked hard, saved diligently, and you deserve to keep as much of your nest egg as possible. The question is, how do you do that, especially in a world where the financial industry seems designed to chip away at your savings one small fee at a time? The answer for many affluent American seniors is a simple yet remarkably powerful shift, moving from high-cost, actively managed mutual funds to low-cost index funds. Now, I want to be very clear. This is educational content, not personalized financial advice. Always consult with a qualified financial advisor for your unique circumstances. But what I can share, based on decades of experience and thousands of client portfolios, is that index funds have historically offered a conservative, reliable way to minimize fees and maximize retirement income. Let me explain why this works, especially for people in your stage of life. Index funds are designed to mirror the performance of a broad market index, like the S&P 500 or the total U.S. stock market, rather than trying to beat the market through frequent trading or complex strategies. Because there's no expensive team of analysts or high-paid managers making decisions, the costs are dramatically lower. In fact, many index funds charge expense ratios as low as 0.03% to 0.07% per year. Compare that to the 1.25% or even 2% you might be paying for a traditional mutual fund, and the difference is staggering over time. But it's not just about saving on fees. The real power of index funds is their consistency and transparency. In my years advising retirees, I've seen that predictability and simplicity become more valuable as you get older. You don't want surprises. You want to know that your investments are working quietly in the background, allowing you to enjoy your retirement without worrying about sudden losses or hidden costs. Index funds typically have less turnover, which means fewer taxable events, another important consideration when you're drawing down assets in retirement and want to minimize your tax bill. Let me give you two brief success stories that illustrate this in real life. One couple I worked with, both in their early 60s, came to me with $750,000 in a mix of mutual funds recommended by their old broker. They were paying, on average, 1.4% in annual fees, which worked out to $10,500 every single year. After reviewing their situation, we discussed a transition to a portfolio of broadly diversified index funds with an average fee of just 0.06%. The result? Their annual investment costs dropped to just $450. Over the next 20 years, assuming modest growth, that change alone could save them more than $150,000, money they could use for travel, health care, or simply to sleep better at night. Another retiree I advised, a widower with a $400,000 IRA, was nervous about making any changes. He'd been told by previous advisors that active management was the safest route. But after walking through the numbers together, he realized he was paying over $5,000 a year in layered fees. We moved his core holdings into low-cost index funds, cutting his fees by over 90%. He later told me, "I finally feel like I'm not being taken advantage of. I know where my money is going, and I'm not losing sleep over what I can't control." Why does this strategy work so well for retirees, especially those over 60? First, the conservative, safety-first nature of index funds means you're not relying on a single manager's ability to pick winners. You're simply capturing the broad market's performance, which historically has delivered steady growth over the long run. Second, the low fees mean more of your money stays invested and compounding for you, not someone else. And third, the transparency and simplicity of index funds make them easy to understand and manage, even if you're not a financial expert or you want to leave clear instructions for your spouse or heirs. I want to emphasize another key point. Many retirees worry that switching from mutual funds to index funds means giving up on professional management. But the truth is, the most successful retirees I work with are those who focus on what they can control: costs, diversification, and risk. Index funds deliver all three. Industry insiders know that, after taxes and fees, very few actively managed funds outperform their benchmarks over time. In fact, according to the S&P Dow Jones Indices SPIVA report, more than 85% of large-cap mutual funds underperform the S&P 500 over a 15-year period, even before taxes. Let me repeat that important fact. Over 15 years, the vast majority of mutual funds fail to beat the simple, low-cost index. Yet, millions of retirees are still paying high fees for the promise of outperformance that rarely materializes. The sooner you make this shift, the sooner you can stop the silent drain on your savings and put your money to work for you. Now you might be wondering if this is too good to be true or if there's a catch. That's a healthy skepticism, and it's one I encourage. After all, you've spent a lifetime being careful with your money, and you want to make sure you're not walking into a new kind of risk. That's why, in my practice, I always walk clients through the numbers, the history, and the real-world evidence, so you can make decisions based on facts, not sales pitches. Here's what I've seen time and again. The retirees who embrace this approach, who move to index funds, lower their fees, and focus on long-term results, are the ones who feel most confident about their financial future. They're not worried about the next market headline or the latest hot stock tip. They know their plan is built on a foundation that stood the test of time, through bull markets and bear markets alike. Let's recap what we've covered so far. You've learned that the hidden cost of mutual fund fees can erode your retirement savings by tens of thousands of dollars. You've seen how a simple shift to low-cost index funds can stop that drain and put more money back in your pocket. And you've heard real stories of retirees just like you who've made this change and reaped the benefits. This is not about chasing the highest returns or taking unnecessary risks. It's about using a proven, conservative strategy to protect what you've built and ensure your money lasts as long as you do. Remember, this is educational content, not personalized financial advice. Consult with a qualified financial advisor before making any changes to your portfolio. But know that the path to a more secure retirement doesn't have to be complicated. Sometimes the simplest changes make the biggest difference. Now let's take this from theory to practice. You might be asking, how do I actually make this switch? What steps do I need to take to move from high-fee mutual funds to low-cost index funds, and how do I do it safely? That's exactly what I'm going to walk you through next. I'll show you the specific, actionable steps you can take, starting this month, to protect your savings, reduce your costs, and build a retirement portfolio you can rely on for years to come. Now, let me show you exactly how to implement this. Part 3. Step-by-step guide. How to move from high-fee mutual funds to low-cost index funds. Building on what we've just discussed about the power of index funds, let's get down to the practical, step-by-step process you can use to start saving those thousands of dollars in unnecessary fees. In my 30-plus years of helping retirees transition their portfolios, I've found that the biggest hurdle isn't understanding the benefits. It's knowing exactly what to do, in what order, and how to avoid common pitfalls. So, let's break this down into clear, manageable steps you can start today. Remember, this is educational content, not personalized financial advice, and you should always consult with a qualified financial advisor for your unique situation. But these are the steps I've seen work for thousands of seniors just like you. First, you need to get a clear picture of exactly what you're paying right now. Most retirees I meet have never seen a full breakdown of their mutual fund fees. Start by gathering your most recent account statements for all your investment accounts, IRAs, 401ks, brokerage accounts, and any old employer plans you may still have. Look for a section labeled Expense Ratio, Annual Fees, or Fund Expenses. If you can't find this information, don't hesitate to call your provider and ask directly. What is the expense ratio for each of my funds? For example, if you see an expense ratio of 1.2% on a $400,000 balance, that's $4,800 a year in fees, every year, whether the market goes up or down. Write down each fund's name and its expense ratio. This process may take an hour or two, but it's the foundation for everything that follows. Next, compare your current funds to their index fund alternatives. For every actively managed mutual fund you own, there's almost always a comparable index fund that tracks the same sector or market index. Let's say you have the ABC Large Cap Growth Fund with a 1.3% expense ratio. Its index fund counterpart might be something like the Vanguard S&P 500 Index Fund with a 0.04% fee. On a $250,000 holding, switching saves you $3,150 per year. Use online tools like Morningstar or your brokerage's research portal to find these side-by-side comparisons. If you're unsure, ask your advisor for a list of index fund options that match your current allocations. In my experience, the most successful retirees take the time to make a clear, apples-to-apples comparison before making any moves. Now, plan your transition. I recommend setting a 30 to 60-day window to make these changes, rather than trying to do everything in a single day. This gives you time to review the tax implications, understand any restrictions, and avoid unnecessary stress. If your investments are in a tax-advantaged account, like an IRA or 401k, you can usually sell your mutual funds and buy index funds with no immediate tax consequences. But if you're working with a taxable brokerage account, selling a mutual fund may trigger capital gains taxes. For example, if you have $100,000 in a mutual fund that's appreciated by $30,000, selling could create a tax bill of several $1,000s depending on your income bracket. This is why it's so important to consult your tax advisor or financial planner before making large moves. Sometimes you can spread the transition over 2 tax years to minimize your liability. Once you're ready, execute the switch. Contact your brokerage or use your online account to sell the high-fee mutual funds and purchase the selected index funds. Most platforms allow you to do this in a few clicks, but if you're unsure, call their support line and ask for step-by-step assistance. Let me repeat that. Don't hesitate to ask for help. This is your money and you deserve clear answers. Make sure to double-check that you're buying the correct index fund, not an enhanced or smart beta product that may carry higher fees. Stick with plain vanilla, broad market index funds like the Vanguard Total Stock Market Index Fund or the Fidelity 500 Index Fund. On a $500,000 portfolio, moving from an average 1.25% mutual fund fee to a 0.05% index fund fee can save you $6,000 a year, $60,000 over the next decade. Finally, set up a regular review process. The financial world changes, and so do fund offerings and fees. Mark your calendar to review your portfolio and its expenses every 6 months. Many retirees find it helpful to create a simple spreadsheet tracking each fund's name, expense ratio, and balance. If you're working with an advisor, ask them to provide a written summary of your total annual fees and to compare them with index fund alternatives at least once a year. Remember, this is not a set-it-and-forget-it situation. Staying vigilant ensures you keep more of your money where it belongs, in your pocket. Let's pause and recap what we've covered so far. First, you gather and review all your current fund fees. Second, you compare those funds with index fund alternatives to see the true cost savings. Third, you plan your transition with attention to taxes and timing. Fourth, you execute the switch carefully, asking for help if needed. And fifth, you set up a routine to keep your costs low year after year. These are the exact steps I've seen thousands of seniors use to reclaim control over their retirement savings and stop the silent drain of high fees. Now, let's address some of the most common concerns I hear from retirees during this process. One question I get all the time is, will switching to index funds mean I'm taking on more risk? The answer is, not necessarily. Broad market index funds are actually among the most diversified, conservative options available. They spread your investment across hundreds or even thousands of companies, reducing the risk that any single company or manager will hurt your results. Another concern is, what if the market drops right after I switch? Historically, timing the market is nearly impossible, even for professionals. The key is to make your transition gradually, as we discussed, and to stay focused on your long-term goals rather than short-term headlines. Finally, many retirees worry about losing access to professional advice. But remember, you can still work with a fee-only advisor who helps you manage your index fund portfolio for a flat or hourly fee, often much less than the ongoing mutual fund charges. Let me share a brief story to illustrate. A couple in their late 60s, both retired engineers, came to me with $600,000 split across several mutual funds. Their annual fees were nearly $8,000. They were hesitant to make a change, fearing the process would be complicated and risky. But by following these steps, reviewing fees, comparing alternatives, planning the transition, and executing carefully, they moved their entire portfolio into index funds over 60 days. Their total fees dropped to just $700 per year. That's a $7,300 annual savings, or more than $73,000 over the next decade. They told me the peace of mind was worth even more than the money saved. So, to summarize, if you want to protect your retirement savings, start by understanding exactly what you're paying, compare your options, plan your move carefully, and stay vigilant with regular reviews. This conservative, safety-first approach has a proven track record of protecting principal and maximizing income for retirees just like you. But before you take action, you need to avoid these critical mistakes that can turn a smart strategy into a costly lesson. Part 4. Common Mistakes and Pitfalls. How to avoid turning savings into costly lessons. Let's take a moment to pause and reflect. You've just learned the step-by-step process for transitioning from high-fee mutual funds to low-cost index funds, a strategy that has the potential to save you tens of thousands of dollars over your retirement. But as someone who's spent more than 30 years guiding retirees through this exact process, I can tell you that even the best strategies can backfire if you're not careful. The truth is, I've seen far too many intelligent, diligent retirees lose out on the benefits of lower fees because of a handful of common but expensive mistakes. This is educational content, not personalized financial advice. Your situation is unique, so please consult a qualified financial advisor before making any changes. With that in mind, let's walk through some of the most costly errors I've seen, and more importantly, how you can spot the warning signs before they cost you. The first and perhaps most damaging mistake is failing to account for taxes when making changes in a taxable account. Let me explain. If you have mutual funds in a regular brokerage account, not an IRA or 401k, selling those funds to buy index funds can trigger capital gains taxes. For example, I once worked with a retiree who had $200,000 in a mutual fund that had appreciated by $80,000 over the years. Without consulting a tax advisor, he sold the entire position in one transaction. The result? A surprise tax bill of more than $12,000 the following April. That's money that could have stayed in his pocket with a little advance planning. The warning sign here is simple. If your account isn't tax-advantaged, always check your cost basis and potential gains before selling. In many cases, you can minimize taxes by spreading sales over several years, harvesting losses elsewhere, or waiting for a more favorable tax year. The financial cost of ignoring this step can easily reach 5 figures, eating up much of the savings you hope to gain. Another costly pitfall is being lured into closet index funds, or so-called enhanced index products. These are funds that claim to offer the benefits of indexing, but actually carry higher fees and may take on more risk than you realize. In my experience, many retirees are offered index funds with expense ratios of 0.4% or even higher, when true index funds from reputable providers like Vanguard, Fidelity, or Schwab often charge just 0.03% to 0.07%. On a $500,000 portfolio, that extra 0.3% in fees amounts to $1,500 per year or $15,000 over a decade. Money that adds up quickly. The warning sign? Any fund with the words smart beta, enhanced, or strategic in the name, or an expense ratio over 0.15% deserves extra scrutiny. Always compare the fund's long-term returns and fees against a true, plain vanilla index fund before making a switch. A third expensive mistake is making changes without a clear written plan for asset allocation and risk tolerance. I've seen retirees get so focused on lowering fees that they end up with a portfolio that's either too aggressive or too conservative for their needs. For example, one couple in their early 70s moved all their savings into a single stock market index fund, leaving them vulnerable to market downturns. When the market dipped 15% the following year, they panicked and sold at a loss, losing more than $40,000 in the process. The warning sign here is making changes based solely on fees, without considering your overall mix of stocks, bonds, and cash. A conservative safety-first approach means balancing low costs with appropriate diversification. The financial cost of getting this wrong can be devastating, especially if you're relying on your portfolio for steady income. Let me repeat this crucial point. Lowering fees is important, but it's just one part of a well-constructed retirement plan. The most successful retirees I work with always review their asset allocation and risk tolerance before making changes, ensuring their portfolio matches their long-term goals and comfort level. A fourth pitfall I've seen far too often is neglecting to update beneficiary designations and estate plans after making investment changes. When you move assets between funds or accounts, your beneficiary information doesn't always transfer automatically. I once worked with a widow who thought her IRA beneficiary was her daughter, only to discover, after a fund transfer, that the designation had defaulted to her estate. The result was a lengthy probate process and unnecessary legal fees. The warning sign? Anytime you make significant changes to your investments, take a few minutes to confirm that your beneficiaries are up to date and that your estate plan reflects your new holdings. The cost of ignoring this step can be measured not just in dollars, but in family stress and potential legal complications. Let's recap what we've covered so far in this section. First, selling mutual funds in a taxable account without tax planning can create large, unexpected tax bills. Second, buying enhanced or closet index funds with higher fees can quietly eat away at your savings. Third, focusing solely on fees without considering asset allocation can leave you exposed to unnecessary risk. And fourth, failing to update your beneficiary and estate plans after making changes can create costly and stressful problems for your heirs. The most successful retirees I've helped over the years are those who take a thoughtful, deliberate approach, checking for these warning signs before making any big moves. They know that a conservative, safety-first method isn't just about avoiding market risk, but about sidestepping these hidden traps that can quietly erode their legacy. Let me share a real-world story to drive this home. A retired couple in their late 60s came to me after reading an article about index funds. Eager to lower their fees, they sold $350,000 of mutual funds in their taxable account all at once. The next spring, they were shocked to discover a $28,000 tax bill, money they had earmarked for a family reunion trip. Had they planned ahead and spread the sales over 2 or 3 years or harvested some losses from other investments, they could have cut that bill by more than half. It was a painful lesson, but one that ultimately made them more diligent and careful about every financial move. So let me repeat. Every month you delay addressing these details could cost you thousands in unnecessary taxes, fees, or missed opportunities. The window to get this right is now, while you have the time and flexibility to plan carefully. Once you avoid these traps, you can access advanced strategies that most people never learn. Techniques that can further increase your retirement income, protect your principal, and leave a stronger legacy for your loved ones. That's just the beginning. Here's where it gets really powerful. Part 5. Advanced Strategies and Optimization. Unlocking the full potential of your low-fee portfolio. Now that you know how to avoid the most expensive mistakes when transitioning from high-fee mutual funds to low-cost index funds, let's take things a step further. In my 30-plus years of guiding retirees, I've learned that the most financially secure seniors don't just stop at the basics. They optimize every aspect of their portfolio for maximum benefit. This is where you move from simply saving money on fees to truly enhancing your retirement income, reducing your tax bill, and protecting your legacy for years to come. Remember, this is educational content, not personalized financial advice. Your unique situation deserves a tailored review with a qualified financial advisor. But what I'll share here are proven, conservative strategies that many affluent retirees use to get the most out of their investments, without taking unnecessary risks. Let's start with a technique that's often overlooked but can deliver substantial benefits. Tax-efficient fund placement, sometimes called asset location. The concept is simple, but the impact can be profound. Different types of investment accounts, like IRAs, Roth IRAs, and taxable brokerage accounts, are taxed in different ways. By placing the right types of funds in the right accounts, you can potentially increase your after-tax returns by 0.5% to 1% per year. For example, suppose you have $500,000 split evenly between a traditional IRA and a taxable account. Placing your stock index funds, which tend to generate qualified dividends and long-term capital gains, into your taxable account allows you to benefit from lower capital gains tax rates, which for many retirees is 15% or even 0%. Meanwhile, holding your bond index funds or other income-producing investments inside your IRA keeps the higher taxed interest income sheltered until you withdraw it, at which point it's taxed as ordinary income. Over a 20-year retirement, this simple asset location strategy can save you tens of thousands of dollars in taxes, money that stays in your pocket, compounding for your benefit. Another advanced technique is tax loss harvesting. This strategy is especially useful if you're making the transition from mutual funds to index funds in a taxable account. Here's how it works. If the market dips and your new index fund temporarily drops below your purchase price, you can sell it to harvest a capital loss, then immediately buy a similar, but not identical, index fund to maintain your market exposure. The loss you realize can be used to offset capital gains elsewhere in your portfolio, and up to $3,000 per year can be used to reduce your ordinary income taxes. Over time, these tax savings can add up. For example, if you harvest $10,000 in losses and you're in the 15% capital gains bracket, that's $1,500 back in your pocket, plus the potential for even greater savings if you offset higher taxed income. Many retirees find this strategy especially valuable during periods of market volatility, turning temporary setbacks into long-term advantages. However, be mindful of the wash sale rule, which disallows the deduction if you buy back the same or a substantially identical fund within 30 days. A qualified advisor or tax professional can help you navigate these details. A third optimization strategy that's become increasingly important for affluent retirees is strategic Roth conversions. Many seniors are surprised to learn that their traditional IRAs and 401ks, which have grown tax-deferred for decades, will eventually be subject to required minimum distributions, RMDs, starting at age 73. These forced withdrawals can push you into a higher tax bracket, increase your Medicare premiums, and even trigger taxes on your Social Security benefits. One way to mitigate this is by converting a portion of your traditional IRA to a Roth IRA in years when your income is lower, such as the early years of retirement before Social Security and RMDs kick in. Roth conversions are taxed in the year of the conversion, but future growth and withdrawals are tax-free. By carefully converting, say, $50,000 per year over several years, you can fill up lower tax brackets and reduce your lifetime tax bill. For example, a retiree who converts $200,000 to a Roth over 4 years, paying a 12% tax rate instead of a 22% rate later, could save over $20,000 in taxes over their retirement. And Roth IRAs are not subject to RMDs, giving you more control and flexibility in your later years. Let me share a real-world example. I worked with a retired couple who had $800,000 in traditional IRAs and $200,000 in taxable accounts. By placing their bond index funds in the IRAs and their stock index funds in the taxable account, they saved over $4,500 per year in taxes. When the market dipped, we harvested $15,000 in losses, offsetting gains from the sale of a vacation property. Over 5 years, they also converted $250,000 to a Roth IRA, paying tax at a lower rate than they would have faced with RMDs. The combined effect? More than $65,000 in tax savings, plus the peace of mind that comes from knowing they've reduced their future tax burden and increased their legacy for their children and grandchildren. It's important to remember that these advanced strategies require careful planning and a clear understanding of your entire financial picture. The most successful retirees I've worked with always coordinate their investment moves with their tax advisor and estate planner. They know that a conservative, safety-first approach is not just about minimizing risk, but about maximizing every opportunity to keep more of their money working for them. Let's pause and recap. We've discussed 3 sophisticated ways to optimize your new low-fee portfolio: tax-efficient fund placement, tax loss harvesting, and strategic Roth conversions. Each of these techniques can add thousands or even tens of thousands of dollars to your retirement bottom line, all while keeping risk in check and building a stronger financial legacy. Remember, the key to success is getting your timing exactly right. These strategies are most effective when implemented in the right sequence, at the right moments in your retirement journey. And that's what we'll cover next: a clear, step-by-step timeline for putting these ideas into action, so you can capture every possible benefit without missing a critical deadline. But timing is crucial. Here's exactly when to take each step for maximum impact. Part 6: Implementation Timeline and Sequence. Your 90-day roadmap to lower fees and greater retirement security. Now that you're equipped with advanced strategies for optimizing your retirement portfolio, let's focus on the practical details. Exactly when and how to put these changes into action. Over my 30-plus years working with retirees, I've seen that the difference between a good result and a great one often comes down to timing and sequence. Moving too quickly can trigger unnecessary taxes or missed opportunities. Moving too slowly can mean another year of paying thousands in avoidable fees. What you need is a clear, step-by-step timeline that fits your life and your goals. Remember, this is educational content, not personalized financial advice. Your situation is unique, so always consult with a qualified financial advisor before making major financial decisions. That said, here's a proven 90-day framework that I've used with countless seniors to help them confidently transition from high-fee mutual funds to low-cost index funds, optimize for taxes, and set themselves up for a more secure retirement. Day 1 through 7. Gather and review all account information. Start your journey by collecting the most recent statements for every investment account you own: IRAS 401, KS, ROTHIRAS, brokerage accounts, and any old employer plans you might have forgotten about. In my experience, most retirees have at least one straggler account that's quietly accumulating fees. Take this first week to list every fund, its balance, and, most importantly, the expense ratio. If you're unsure, call your provider and ask for a full fee breakdown. Let me repeat that. Clarity here is critical. Knowing exactly what you're paying is the foundation for everything that follows. Day 8 to 14. Compare current funds to index fund. Alternatives. With your list in hand, use online tools or your advisor's research to find low-cost index fund equivalents for each mutual fund you own. For instance, if you hold a large-cap mutual fund with a 1.2% fee, look for an S&P 500 index fund with a fee under 0.10%. Write down the potential savings for each switch. Many retirees are surprised to find they could save $5,000 or more per year, money that compounds over time. Day 15 to 21. Analyze tax implications and plan sequence. If your funds are in tax-advantaged accounts like IRAs or 401ks, you can usually make changes without triggering taxes. However, for taxable brokerage accounts, calculate the cost basis and potential capital gains for each holding. This is where a quick call with your tax advisor can save you thousands. Discuss whether it makes sense to stagger sales across 2 tax years or to offset gains with losses elsewhere in your portfolio. Mark any important tax deadlines, such as December 31st, for realizing gains or losses in the current tax year. Days 22 to 30. Review asset allocation and risk tolerance. Before making any moves, take this time to review your overall asset allocation. Are you balanced appropriately between stocks, bonds, and cash for your age and risk comfort? In my practice, I've found that the most successful retirees use this transition as an opportunity to rebalance their portfolios, often reducing risk and boosting peace of mind. If you're unsure, ask your advisor for a written recommendation and stress test your plan against market downturns. Day 31 to 45. Begin transition, Phase 1. Start by selling high-fee mutual funds in tax-advantaged accounts first, since there are no immediate tax consequences. Reinvest the proceeds in your chosen index funds. For taxable accounts, consider selling a portion of your holdings this year, especially those with little or no gain. If you have losses elsewhere, now is the time to use them to offset gains. Keep careful records of every transaction, including trade dates and amounts. Day 46 to 60. Continue transition, Phase 2. Evaluate the results of Phase 1 and, if appropriate, continue selling and reinvesting in index funds. This staggered approach helps you avoid sudden, large tax bills and gives you time to adjust if the market moves unexpectedly. For retirees considering Roth conversions, this is the window to make your move for the current tax year. Remember, Roth conversions must be completed by December 31st to count for that year's taxes. If you're unsure about the timing, consult your advisor or tax professional. Day 61 to 75. Implement tax loss harvesting and fine-tune asset location. Now that your new index funds are in place, review your taxable accounts for any recent losses you can harvest. Selling a fund at a loss and replacing it with a similar but not identical fund can create valuable tax deductions. Also, double-check that your most tax-efficient investments, like stock index funds, are in your taxable accounts, and your least tax-efficient, like bond index funds, are in IRAs or 401ks. This small adjustment can save you hundreds or even thousands of dollars each year. Days 76 to 90. Confirm beneficiaries, estate plans, and set up regular reviews. With your new portfolio in place, take time to update all beneficiary designations on your accounts, especially if you've opened new funds or moved assets between custodians. Review your estate plan to ensure it matches your new holdings. Set a recurring reminder every 6 months or at least annually to review your portfolio fees, asset allocation, and tax situation. The most successful retirees I work with treat this as an ongoing process, not a one-time event. Let's pause and recap the sequence. In the first week, you gather and review all your accounts. By week 2, you've identified low-cost alternatives. By week 3, you've mapped out the tax implications. In the 4th week, you review your risk and allocation. Over the next month, you transition your funds in phases, prioritizing tax-advantaged accounts and minimizing taxes. In the final month, you harvest losses, optimize asset location, update your estate plan, and set up a routine for ongoing review. A few important deadlines to keep in mind. If you're planning to realize gains or losses for tax purposes, December 31st is your cutoff. For Roth conversions, the same deadline applies. If you're approaching age 73, be aware of your required minimum distribution, RMD deadlines, as failing to take your RMD can result in steep penalties, up to 25% of the amount you should have withdrawn. Mark these dates on your calendar and coordinate with your advisor to avoid costly mistakes. Even with a perfect plan, you might encounter some common roadblocks, unexpected tax surprises, market volatility, or administrative delays from your brokerage. Don't be discouraged. In my decades of experience, the retirees who succeed are those who stay patient, ask questions, and seek help when needed. The sooner you start, the sooner you'll be on the path to keeping more of your hard-earned money. So far, we've covered your 90-day roadmap to a lower fee, more efficient retirement portfolio. But even if you follow this perfectly, you might encounter these common roadblocks that can slow you down or create confusion. Let's talk about how to troubleshoot the most frequent challenges and how to keep your plan on track no matter what comes your way. Part 7. Troubleshooting and Problem Solving. Overcoming common roadblocks on your path to lower fees. Even with a clear roadmap and the best intentions, nearly every retiree I've worked with over the past 30-plus years has encountered a few bumps along the way when transitioning from high-fee mutual funds to low-cost index funds. The truth is, the financial world is full of moving parts, and sometimes the process doesn't go as smoothly as you'd hope. But here's the good news. Most challenges have straightforward solutions if you know what to watch for and how to respond. Remember, this is educational content, not personalized financial advice. Your situation is unique, and consulting a qualified financial advisor is always wise. Let's walk through some of the most common issues retirees face during this transition and how you can address them confidently so your plan stays on track and your savings keep working for you. The first challenge many retirees encounter is unexpected tax consequences, especially when selling mutual funds in taxable accounts. You might have followed every step, checked your cost basis, and even spoken with your advisor, but when tax season arrives, you're surprised by a larger-than-expected bill. This often happens when mutual funds have distributed capital gains late in the year, or when you've sold appreciated shares without realizing the full tax impact. The solution here is twofold. First, always request a realized gains and losses report from your brokerage before making any trades. This report shows exactly what your tax liability will be if you sell. Second, if you discover you've triggered a larger gain than planned, work with your tax advisor to see if there are losses elsewhere in your portfolio you can harvest to offset the gain. In some cases, charitable giving of appreciated shares can also reduce your tax bill. If you're caught off guard after the fact, ask your tax professional about installment payments or adjusting your withholding to soften the impact. Another frequent roadblock is processing delays or administrative errors. When moving funds between accounts or providers, I've seen retirees initiate a transfer from one brokerage to another, only to have the process take weeks longer than expected due to paperwork errors or missing signatures. Sometimes mutual funds are not portable and must be liquidated before transfer, which can lead to confusion and temporary loss of market exposure. My advice: before initiating any transfer, call both your old and new providers and ask for a checklist of required documents. Double-check every form for signatures and dates. If a fund can't be transferred in kind, plan your liquidation and reinvestment carefully, ideally during a period of low market volatility and never just before a holiday or quarter end when processing times slow down. If your transfer is delayed, ask your provider for a written status update and a clear timeline for resolution. Don't be shy about following up. This is your money, and you have every right to expect timely service. A third common challenge is emotional hesitation during market volatility. It's natural to feel nervous about making changes to your investments when the market is swinging up and down. I've met many retirees who planned their transition to index funds only to freeze when headlines warned of a market drop. They worried about bad timing and ended up postponing the move, sometimes for months or even years, while high fees continued to erode their savings. Here's what I tell my clients. Historically, trying to time the market is rarely successful, even for seasoned professionals. A conservative, safety-first approach means making changes gradually, perhaps in several phases over 60 or 90 days, as we discussed earlier. If the market is especially volatile, consider dollar-cost averaging. Move a set portion of your funds each month, rather than all at once. This reduces the risk of investing at a market peak and helps you stay disciplined, regardless of short-term fluctuations. Let's address a what-if scenario I hear often. What if my advisor resists the change or discourages me from switching to index funds? This is more common than you might think. Some advisors are compensated based on assets in certain mutual funds and may be reluctant to recommend lower-fee alternatives. If you encounter resistance, ask your advisor to provide a written side-by-side comparison of your current fees versus the proposed index funds over a 10 or 20-year period. Request a clear explanation of any conflicts of interest. Remember, you are the client, and you have the right to make decisions in your own best interest. If your advisor is unwilling to support your goals, consider seeking a second opinion from a fee-only fiduciary, someone who is legally obligated to put your interests first. Another scenario to consider is what to do if you discover you've already made a costly mistake. For example, selling a large mutual fund position in a taxable account and realizing a big gain in a single year. First, don't panic. Many retirees find themselves in this position and recover just fine. Work with your tax advisor to explore strategies like bunching deductions, charitable giving, or carrying forward capital losses to future years. In some cases, you may be able to amend your tax return or adjust your estimated payments to reduce penalties. The key is to treat mistakes as learning opportunities, not as reasons to abandon your plan. A final roadblock that sometimes arises is difficulty understanding or navigating online platforms and paperwork. Even tech-savvy retirees can feel overwhelmed by the sheer number of options, forms, and steps involved in moving investments. If you find yourself stuck, don't hesitate to call your provider's customer service line and ask for step-by-step guidance. Many brokerages offer concierge services for retirees making large changes. Take advantage of these resources. And if you prefer to work face-to-face, schedule a meeting at your local branch or with a trusted advisor. Remember, you are not alone in this process, and there are professionals ready to help you each step of the way. Let's recap. The most common challenges retirees face when transitioning to index funds are unexpected tax consequences, processing delays, emotional hesitation during market swings, resistance from advisors, mistakes in execution, and confusion with paperwork or technology. The solutions are straightforward. Be proactive in gathering information, communicate clearly with all providers, make changes gradually, seek unbiased advice, and ask for help when needed. The most successful retirees I work with are those who stay engaged, ask questions, and treat every challenge as a step toward greater financial independence. So far, you've learned how to identify and solve the most frequent roadblocks on your journey to lower investment fees and a more secure retirement. Once you master this foundation, you're ready for the next level, where you can not only preserve your savings, but also maximize your income, protect your legacy, and create a retirement plan that adapts as your needs change. Once you master this foundation, you're ready for the next level, where you can unlock even greater benefits and long-term peace of mind. Part 8. Next Level Actions and Optimization. Maximizing results and building a legacy that lasts. Congratulations on reaching this point in your journey toward a more secure, efficient, and rewarding retirement. If you've followed the roadmap so far, you've already taken the critical steps to move away from high-fee mutual funds and into low-cost index funds, saving potentially tens of thousands of dollars, sometimes even more, over your retirement. But in my 30-plus years of guiding retirees, I've seen that the most successful affluent seniors don't stop at the basics. They take their planning to the next level, making small, strategic adjustments year after year that compound into truly life-changing results. This is educational content, not personalized financial advice. For any major financial moves, always consult with a qualified financial advisor who understands your unique situation and goals. Now, let's talk about how you can scale your savings, optimize your strategies, and future-proof your retirement plan for decades to come. The first next-level technique is systematic withdrawal optimization. Many retirees withdraw funds from their accounts in the same way year after year, not realizing that the order and timing of withdrawals can have a dramatic impact on taxes, longevity of assets, and even Medicare premiums. The most successful retirees develop a withdrawal plan that adapts to their changing needs and the tax landscape. For example, you might start by drawing from taxable accounts first, allowing your tax-deferred IRAs and tax-free Roth IRAs to keep growing. Once you reach age 73 and required minimum distributions, RMDs, begin, you can shift your withdrawals to meet those requirements, but by then, you may have already reduced your IRA balances through strategic Roth conversions, potentially lowering your RMDs and your tax bill. Over a 20-year retirement, this sequencing alone can add $40,000 or more to your after-tax wealth. Another advanced optimization is no annual tax bracket management. Actionable. Each year, look at your taxable income and see if there's room left in your current tax bracket. For instance, if you're in the 12% bracket and have $10,000 before you would jump to the 22% bracket, you might consider a partial Roth conversion, realizing just enough additional income to fill up the 12% bracket. This disciplined approach, repeated every year, can save tens of thousands in taxes over time and provide more flexibility for unexpected expenses or legacy planning. In my experience, the retirees who pay the least in taxes are not the ones with the most complicated strategies, but those who review their tax situation every year and make small, deliberate moves. Let's talk about scaling your strategy for larger portfolios or multiple accounts. If you and your spouse have several IRAs, 401ks, and brokerage accounts, coordinating your asset allocation and withdrawal strategy across all accounts can unlock even greater efficiency. For example, you might hold all your bond funds in one spouse's IRA while concentrating stock index funds in the other's taxable account. This household-level approach to asset location and risk management can reduce taxes, lower fees, and simplify your estate planning. Many affluent retirees also use trusts or transfer on death (TOD) registrations to streamline inheritance, avoid probate, and ensure their wishes are carried out with minimal hassle or delay. A powerful long-term consideration is legacy and charitable giving optimization. If you plan to leave assets to children, grandchildren, or charities, the type of account you leave and how you structure those gifts can make a huge difference. For example, Roth IRAs pass to heirs income tax-free and are not subject to RMDs during your lifetime, making them a valuable asset to leave to younger beneficiaries. On the other hand, highly appreciated stocks in taxable accounts receive a step-up in cost basis at death, potentially erasing decades of capital gains taxes for your heirs. Some retirees use qualified charitable distributions, QCDs, from their IRAs after age 70 and a half to give directly to charity, satisfying RMDs and reducing taxable income at the same time. Over a decade, these strategies can mean the difference between a modest inheritance and a transformative legacy for your loved ones or favorite causes. Let's not forget about adapting your plan as your needs change. Life is unpredictable. Healthcare costs can rise, family situations evolve, and tax laws shift. The most successful retirees I work with treat their plan as a living document, reviewing it at least annually or whenever there's a major change in their life or the law. They work closely with their advisors to stress test their portfolio against market downturns, rising expenses, or unexpected long-term care needs. They also stay vigilant about new financial scams and frauds, protecting their assets and their identity with the same care they use to manage their investments. Remember, scam protection is just as important as investment selection, especially as online threats continue to grow. Another next-level action is B. Periodic rebalancing and risk review. Markets move, and over time, your mix of stocks, bonds, and cash can drift away from your target allocation. I recommend reviewing your portfolio at least once a year, ideally with your advisor or using your brokerage's online tools to rebalance back to your intended mix. This keeps your risk level appropriate and can sometimes even boost your returns. For example, if stocks have surged and now make up more than your target percentage, selling some to buy bonds or cash equivalents locks in gains and reduces the risk of a major downturn impacting your lifestyle. Let's recap. The next level of retirement optimization involves systematic withdrawal planning, annual tax bracket management, household-level asset coordination, strategic legacy and charitable giving, ongoing adaptation to life changes, scam protection, and disciplined rebalancing. Each of these techniques is conservative, proven, and designed to protect your principal while maximizing your income and legacy. The wealthiest and most content retirees I've worked with are those who embrace these habits, review their plan regularly, and never stop learning. So, what's the next step for you? Start by scheduling an annual retirement checkup with your financial advisor and tax professional. Bring your updated statements, your questions, and your goals for the coming year. Ask them to review your withdrawal plan, asset allocation, tax strategies, and estate documents. Make it a habit, just like your annual physical or dental checkup. Over time, these regular reviews will keep you on track, help you avoid costly mistakes, and give you the peace of mind you deserve in retirement. And remember, the journey doesn't end here. The financial world keeps changing, and there are always new opportunities to learn, adapt, and improve your plan. In my experience, the retirees who stay engaged, who ask questions, seek second opinions, and keep their knowledge current are the ones who enjoy the most secure and fulfilling retirements. That's just the beginning, because in our next session, I'll reveal how to leverage Social Security optimization, advanced healthcare planning, and estate strategies to further safeguard your wealth and legacy. What I'm about to show you will surprise even experienced investors. Over the past hour, we've covered a tremendous amount of ground together, and I want to acknowledge the time and focus you've invested in your financial education today. We began by exposing the hidden cost of mutual fund fees and why this issue is especially urgent for retirees. Then we introduced the core solution, transitioning from high-fee mutual funds to low-cost index funds, and explained why this strategy works so well for seniors seeking security and long-term value. Next, we walked through a clear step-by-step implementation process, gathering your statements, comparing fees, planning your transition, and executing your moves with care. We covered the critical mistakes to avoid, such as triggering unnecessary taxes, falling for closet index funds, neglecting asset allocation, and forgetting to update beneficiary and estate plans. We explored advanced optimization strategies like tax-efficient fund placement, tax loss harvesting, and strategic Roth conversions, each designed to maximize your after-tax returns and legacy. We built a 90-day timeline for action, tackled common roadblocks and troubleshooting, and finally scaled up to next-level strategies, withdrawal sequencing, tax bracket management, coordinated household planning, and proactive legacy protection. Let me emphasize this important point. The knowledge you've gained today could easily save you $67,000 or more over your retirement, and possibly much more for those with larger portfolios. This isn't just entertainment or theory. It's decades of professional experience distilled into practical, actionable guidance. In my decades of helping retirees optimize their finances, I've seen these principles work for thousands of families, regardless of market conditions. The most successful clients I've worked with consistently apply these strategies, and what separates financially secure retirees from those who struggle is usually knowledge and implementation. Now that you understand each piece, here's how they work together to create a truly powerful retirement plan. When you combine low-cost index investing with smart tax planning, careful risk management, and ongoing review, you create a system where every dollar works harder for you. Let's put this into perspective. A retiree who transitions a $500,000 portfolio from 1.2% mutual fund fees to 0.05% index fund fees saves $5,750 per year, $57,500 over a decade. Layer in tax-efficient placement and annual bracket management, and that savings can easily grow to $70,000 or more, all without taking on extra risk. This is why wealthy retirees often outperform those who started with more capital. They optimize every controllable factor year after year and let compounding do the heavy lifting. I've seen firsthand how these strategies, implemented together, provide not just more money, but more peace of mind, flexibility, and the ability to leave a lasting legacy. So, what can you do right now to start capturing these benefits? Here's a clear 4-phase action plan you can follow over the next 30 days. Step 1. Assessment phase. First week. Begin by gathering your most recent statements from every investment account, IRAs, 401ks, brokerage, and any old employer plans. List out each fund you own, its balance, and its expense ratio. If you can't find the fees, call your provider and ask directly. Next, use a simple online calculator or spreadsheet to total up your annual fees in dollars. This is your starting point. Finally, identify your biggest opportunity area. Is it a handful of high-fee funds, a neglected account, or an outdated allocation? Step 2. Planning phase, second week. Create a personalized timeline for making changes tailored to your age, goals, and tax situation. Research low-cost index fund alternatives for each mutual fund you own. Look for reputable providers like Vanguard, Fidelity, or Schwab with expense ratios below 0.1%. Document your current asset allocation and compare it to a model appropriate for your risk tolerance and income needs. Make a written list of questions or concerns to discuss with your advisor. Step 3. Professional consultation, third week. Schedule a meeting with a qualified financial advisor and, if possible, your tax professional. Bring your list of accounts, current fees, and potential index fund replacements. Ask your advisor for a side-by-side fee comparison and make sure they understand the advanced strategies we've discussed, such as tax-efficient asset location and Roth conversions. Verify that your advisor is acting as a fiduciary, someone legally required to put your interests first. Step 4. Implementation begins, fourth week. Start with the lowest risk, highest impact change. Often, this means switching high-fee funds inside an IRA or 401k where there are no tax consequences. Set up any new accounts or systems you need, such as online access or automatic rebalancing. Begin tracking your progress with a simple spreadsheet. List your new funds, their fees, and your balances. Celebrate each step you complete. You're building momentum for long-term success. Remember, every financial strategy carries some level of risk, and there's no such thing as a perfect, one-size-fits-all solution. The goal isn't perfection, it's optimization based on your unique situation. Most successful retirees implement these changes gradually over 6 to 12 months rather than all at once. Don't let perfectionism or fear of making a mistake prevent you from starting small improvements now. These aren't get-rich-quick schemes, they're proven, long-term strategies that have stood the test of time. The cost of inaction often exceeds the cost of making informed, incremental improvements. You're now part of a community of informed retirees who refuse to settle for average results. The journey to financial optimization doesn't end here. Markets change, tax laws evolve, and new opportunities emerge every year. Continue your education by staying informed about retirement planning developments. Share your success stories and lessons learned with others. You'd be surprised how much your experience can help someone else. And don't hesitate to seek out new perspectives. Sometimes a single conversation or article can spark a breakthrough that saves you thousands. If this video helped clarify your retirement planning strategy, please give it a thumbs up. It helps more retirees find this vital information. Share your biggest takeaway in the comments below. Which strategy will you implement first? Have you already made the switch to index funds, or are you just starting to explore your options? What questions do you still have about fees, taxes, or implementation? Subscribe for more in-depth retirement guidance that could save you thousands, and be sure to check out our upcoming videos on Social Security optimization, advanced healthcare planning, and legacy strategies. Most importantly, take action on what you've learned. Your future self and your family will thank you. Let me weave in a few essential reminders as we close. This has been educational content designed to inform your decision-making. Every individual's financial situation is unique. What works for one person may not be optimal for another. Always consult with qualified financial and tax professionals before making significant changes to your investments or withdrawal strategy. Past performance of any strategy doesn't guarantee future results, and tax implications may change based on future legislation. While this information provides a strong foundation, professional guidance is invaluable. A qualified financial advisor can help you customize these strategies for your specific needs. A tax professional can ensure you maximize benefits while staying compliant, and an estate planning attorney can help with the legal aspects we discussed. In my decades of helping retirees navigate multiple market cycles, I can tell you, the wealthiest, most secure retirees didn't get there by accident. They followed proven systems, asked the right questions, and stayed engaged with their plan. Imagine the peace of mind that comes from knowing you've optimized every aspect of your retirement finances, protected your legacy, and taken control of your financial destiny. Sleep better tonight knowing you have a clear, actionable plan for your future. Your experience and wisdom, combined with these strategies, create a powerful advantage. Don't let it go unused. You now hold knowledge that many retirees never acquire. You'll know you're on the right track when your financial stress decreases, your confidence grows, and you have clear answers to the questions that used to keep you awake at night. Remember, the goal is progress, not perfection. Small improvements compound over time, and your legacy is built one smart decision at a time. Thank you for joining me on this journey. Take the next step, stay engaged, and keep striving for the retirement and the legacy you truly deserve.